binge for over 30 years, between 30 and 40, depending on which sector you look at, households, businesses, and government. We are now in more debt than we have been since the Civil War, so 140 years. That includes the Great Depression, the First Great Depression. That includes even World War II. We're in more debt today than we've ever been since 1870. That's as far back as the data went. I tried to look, I couldn't find it. It might even be longer than that, but it's at least 1870. And nobody has a plan, at least in the public sector, to pay it back. This is a big divergence now in the public sector and in the private sector. You know, people talk about the paradox of thrift. Well, in reality, people realize, at least in the private sector, that we are broke. Right? People realize that that they have gone too far, that their debts relative to their income had gotten out of whack, and they're paying off debt. If you think about your own life, if you think about family, you think about friends, you think about colleagues, whatever, if you work, you know, very few people are taking out big new mortgages right now. Home sales have been down for every year for the last 5 years running. Okay, same thing with auto sales. Auto sales are now at their lowest rate since 1982. In 1982, the economy was 1/3 the size that it is today. Okay, so our economy since 1982 has grown 3 times as large, but we're running the same number of auto sales per year. I think it's about 10.5 or 11 million. So we are at the lowest level of auto sales. We're at home sales, you know, declining dramatically. Same thing with credit cards. Most people I know are paying off credit card debt. Credit has been declining in this country for 2 years, private sector credit. So, you know, people have finally realized that they went too far and they're pulling back. And it's going to be ugly, it's going to be messy, but it's like a hangover, right? You drink, you drink, you drink. The next morning you gotta wake up. You can't just keep drinking. At some point you realize I gotta stop drinking. The private sector is there. The public sector, the government, unfortunately, continues to borrow. This year alone, we are going to borrow $1.3 trillion. That is 9% of our GDP. It is the largest deficit that we have ever run. Last year and this year, the largest deficits that we have ever run in the history of the country. Going back as far as I could get the data, I think it was back to certainly to the 1900s. With the exception of World War II. I think in World War II we had a couple of years where we ran deficits of like 20% of GDP. But obviously that was for a very specific purpose, and you had to do it. World War II, you have to fight it, okay, fine. You know, everybody kind of pulls together, you know, you make the sacrifice, you fight the war, and then we pulled back, spending came down. 9% of GDP is more than we ran during the Great Depression. During the Great Depression, I think the biggest deficit, I'd have to go back and look specifically, the biggest deficit I think was around 5% of GDP. So we're running a bigger deficit today than we ran during the Great Depression. So, you know, the same clever people like Krugman, when he says, well, we can just keep borrowing and borrowing and borrowing like we've been doing for 40 years and we can do it into the foreseeable future and there are no consequences, those guys are sooner or later going to be wrong. You know, maybe it's not this year, maybe it's not next year, but at some point the piper has to be paid. We've got to pay this money back. CBO, the Congressional Budget Office, is projecting that we are going to run trillion-dollar deficits for the foreseeable future. I think their most reliable projections that I've seen go out to 2019, and they're literally trillion-dollar deficits going out until 2019. This is not sustainable. You know, to the people in this room, even though you guys are students, you realize that you've got to pay this money back. Anybody who's ever run a business realizes at some point you have to pay the money back. The principle, you know, for people who think, well, the principle doesn't apply to governments, it does apply to governments. If you guys, anyone following the situation in Greece? Yes? Más o menos, a little bit? All right. So the situation in Greece is that they've gotten themselves into a pickle. They've been borrowing and borrowing and borrowing, and now they're in trouble. And we'll get into the details in a minute, but if you think about what happened back the first week of May, I think it was May 6th or maybe May 7th, the Dow Jones in this country, within the span of a few minutes, dropped almost 1,000 points. They call it the flash crash. Anybody hear of that? You guys remember that? Okay. The reason that that was triggered is because at the same time, it was triggered around noon or 12:30 on that day. At that time in Greece, there was rioting in the streets because the public was becoming aware that this deficit problem that they were having was going to impact their checks, was going to impact their budget. And so they were rioting. And so because of the rioting in Greece, the Dow Jones fell 1,000 points. So there are consequences that are going to hit us. The problem that Greece is facing is that when you borrow more and more money, right, more and more of your income, more and more of your tax revenue has to go to pay interest on the debt. And so you can't pay back as much in principal. And so the principal as a percentage of your income tends to grow. That's what happened in Greece. Now it's one thing if you have a plan to pay back the money that you borrow. Like after World War II, we shut down a lot of government spending. There was some spending that remained, but the economy was able to grow. You have to remember the world was also a very different place after World War II. Europe was in shambles, right? Japan was not a great industrial powerhouse, it was a defeated nation. China was getting ready to go communist. So there was really not that much competition in the world. And so we were able to grow at big rates, and we did grow at big rates, and we brought down our debt. We also cut spending. What happened in Greece is that they borrowed so much money that the market began to doubt whether or not they could ever pay this money back. And so as a result, when the market looks at that, Greek debt started to look very risky. And so interest rates on Greek debt basically skyrocketed, right? When those interest rates skyrocket, you look like a more risky nation, risky debtor. It makes it harder for you to borrow, so you have to pay more money to borrow what you want to borrow. So when you pay more money to borrow, obviously your balance sheet looks even worse because now you've got all this interest that you've got to pay, and you have the same amount of revenue because interest rates are just the price of money. The price of money goes up, it becomes even more difficult, and so then the market says, well, if you have to pay a higher rate of interest, then all of our assumptions, all of our models have to be adjusted, and you get even more risk, and then you have to borrow more money, and the interest rates go up, and you end up in a big vicious cycle. That's what happened to Greece. It started basically in October of last year. By May of this year, they had to go to the EU to get a bailout. The situation in Greece, we don't think has been fully resolved. It looks to us like they've just kicked the can down the road a couple of years. Maybe it'll be a year, maybe it'll be 2, maybe it'll be 3 at the most. And Greece and the rest of the pigs are going to be back at the trough, either needing another bailout, or they're going to be right back where they started from, except with more debt, because they just keep on borrowing more money. And the thing is, if we don't change in this country, we're going to face the same issue. Right now, as it is, we spend about $400 billion a year in interest alone, right? That's about 10% of our national budget. Our national budget, I think, last year was somewhere around $3.5 or $3.7 trillion. And we're spending about $400 billion out of that call it $3.6 trillion, about $400 billion is spent just on interest on the national debt. That's an environment, $400 billion is in an environment where our debts are going to continue to rise, so that $400 billion, even at current interest rates, is going to go up. And if the market ever gets concerned about where we are with regards to our debts, the interest rates are going to rise on our debt because we're going to look riskier because our debts just keep going up, as with Greece. And so that rising interest rates, even at a flat level of debt, rising interest rates are going to eat up even more interest payments, right? We're going to have to pay higher rates of interest. So we're in a situation right now where we have a certain level of debt and we have 0% interest rates. The debt is rising, and there's a very good chance that interest rates are going to rise. So we are really at the precipice of a significant problem. It's going to happen here. It happened in Greece. It's going to happen in other countries. The British right now are trying to avoid this. They're making big cuts. Anyone following what's going on in Great Britain? Okay. You know, guys? Okay. Great Britain is trying desperately to implement a lot of austerity measures for this reason. They're a little closer to the edge of the cliff than we are, but we're headed the same direction. We're headed there. Being in debt is no fun, but that's where we are, and I think this should be really a big wake-up call. I mean, this is not a standard recession, as I said a minute ago. I don't think people fully realize. I think in the private sector, people do realize. In the public sector, they don't realize just where we are. We're at a very dangerous point in our history, and if we don't turn things around soon,